I'm very excited to be here and open this new session, which will hopefully be fast, furious, and fun. So it's 3 Fs. See, you should add that for the next. Okay, so I'm going to talk about this project that was a lot of fun to work with, Jason, Sandvik, and Vivi. And this paper will look about at CEO activism and firm value. But let me get started with telling you what is CEO activism. So CEO activism, this is a practice of CEOs taking public stances and expressing their views publicly on social and political issues which may or may not be really directly related to their core businesses. And this practice has grown a lot over the last decade because previously CEOs rarely plunged into this like social and political debate, but over the past decade, more and more CEOs started expressing their views. For example, Tim Cook, Apple CEO, he numerous times expressed his support for LGBTQ rights, or Bob Iger speaks about gun control, or CEOs of Coca-Cola and Delta criticize Georgia voting law. So we study this phenomena, and to do that, we collect data, we scrape Google News and Twitter, and we look for a combination of a CEO name or a firm name and some keywords that would characterize the social and political debates, right? And then once we collect the data, we clean it really intensively. And as a result, we identify about 1,400 instances of CEO activism. So most frequently in our sample, CEOs talk about things related to diversity, inclusion, Trump, environment, climate change. So with this data, we basically try to do 3 things. First, we want to know why CEOs choose to make this public, take these public stances. Second, what is the effect of this, if there is any, on firm value? And third, what are the ramifications of CEO activism for CEOs themselves? Okay, so for the first one, there are some papers that have made like theoretical arguments about why CEOs might choose to engage in CEO activism. And some argue that this CEO activism is a manifestation of CEOs' personal beliefs, so it stands for CEOs' personal values. Others that said that in addition to that, it could be that it's an articulation of corporate values or beliefs that firms should do a little bit more than just maximize shareholder value. It could be a combination of those. It could also be in response to the demands of stakeholders. And this kind of supported in the survey evidence that suggests that younger consumers and younger employees, they actually want their CEOs and their companies to take public stances on issues that are important to them. So we test these theoretical predictions using our data, and what we find that yes, CEOs' personal beliefs are important in predicting that CEO will actually take a public stance, as we see that CEOs that have greater democratic leaning are more likely to make more liberal statements. What we also find is that the ideologies of other stakeholders, like employees, consumers, and investors, is also important. And whereas those ideologies cannot convince an otherwise reluctant CEO to engage in activism, the alignment of their beliefs with the beliefs of the CEO can actually prompt a CEO to speak out. So if you have a democratically leaning CEO and you have a democratically leaning workforce or investors, then CEO is more likely to speak up. We also find that some CEO characteristics help predicting CEO activism. We find that younger CEOs are more likely to express their opinions publicly, also more visible and more powerful CEOs. Okay, on to the firm value. So ex-ante, it's not clear what will be the outcome of CEO activism, if any, on firm value, because on one side, you can think that a lot of institutional investors over the last decade placed a lot of importance on issues related to corporate social responsibility and sustainability, so they might perceive CEO activism as an additional signal about company strategy related to social and political issues. Alternatively, CEOs may react negatively because either what CEO says is really contradicts, doesn't align with the views of investors or other stakeholders, or because they simply think that CEO shouldn't act as a political or social activist. So what do we find? We find modest but positive market response to these public stances. Importantly, not all of the public stances generate a positive response. Market responds positively when CEOs talk about diversity and environment, but doesn't really respond positively when CEOs talk about politics. We find that these announcement returns are higher if these public stances are more credible. And more credible, we measure it 2 ways. One, if they're accompanied by some kind of action, it's not just talk. And also if the stance that they take actually align with their political contributions. We also find, in contrast, that the CEOs' statements that are more counter-normative and riskier, that they generate lower market response. And lastly, not all firms benefit from this CEO activism, but rather firms that operate in more competitive and polarized environments where there is a higher need to stand out and differentiate yourself. That's where announcement returns are higher. What we find also is that this positive market reaction can be explained potentially by investors' socio-political preferences, as we find that investors, institutional investors that have greater democratic or liberal leaning, they increase their ownership in these firms and rebalance their portfolio towards these companies, which means that there are certain investors that have strong enough preference for CEOs to speak out. Last thing, we look at the ramifications of CEO activism for CEO themselves, because boards of directors, they could view it positively given the positive market response to CEO activism and take into account investors' preferences for it, or they could view it negatively and fire CEO regardless. So what we do find is that CEOs that take public stance, they are less likely to be fired. However, this relationship is only present when the stances that they take generate positive market response. Now, we do not find that when CEOs say something that results in a negative response that they are more likely to be fired, so the relationship there is insignificant. But we do find is when this activist stance are accompanied by extreme negative stakeholder reaction, such as boycotts, then CEOs are more likely to be dismissed. So overall, there is a clear upward trend of CEO activism. It can be spurred by CEOs' personal beliefs as well as the ideologies of important stakeholders. On average, it's a very modest but positive market reaction, and boards seem to view it very positively. That's all. Thank you. Very fast? Too fast?
That was great. Thank you, Anya. Any comments, questions?
Well, you talked very fast, so thank you very much. I appreciate that. Did you look at all at the public disclosures around these issues that were made by companies, whether or not they were consistent or not with the positions that the CEOs were taking?
No, that's a very good question. So when we look at CEO activism, we actually include the statements that are not made just by CEOs, but also by their firms. And that makes it a little bit hard because it's very hard to isolate whether it's a CEO's personal position or is it official position of the company. So we only looked at so as long as our measure might capture some of the instances that you are saying, but we haven't looked at other disclosures to see if they align or not. But I think that would be an interesting thing to do.
Well, thank you. I read your papers.
Oh, thank you.
So I have 3 questions. I'm going to add one only. Because it's relevant to that. So if you are concerned about whether or not this is driven by CEO or not, maybe you can look at the sample where you look at foreign CEO and look at their hometown or country of origin where they have some sort of outreach or attention to this issue. So then it's more isolated to the CEO origin only.
Oh, okay. Yeah, that would be interesting. Okay. Yeah, I don't know how many foreign CEOs we have. We look at S&P 500, but maybe we'll have some. And I don't know whether foreign CEOs are actually more likely to talk or not, but this is something we can look at. Thank you.
Any other questions, comments?
Well, can I abuse my privilege a little bit? And you show that you find that democratic leaning CEOs are more likely to speak up. So is this a democratic effect, or is this an effect driven by the sample period that you're studying, where you have Republican presidents in charge, and then you have misalignment between the CEO's political ideology and the administration in place?
Yeah, that's a very good question. So most of our CEO activism events are in the later period, right, so 2016, 2019, right? And I will also say that majority of our events, like 90% of them, are liberal. So there are very few actually conservative stances for some reason. But it could be very much, as you said, because it coincided with this balance, right, this alignment.
My suspicion is that if you extend the sample to more recent periods, you may actually see something a little different. The misalignment the effect may kick up.
Yeah. Mm-hmm. Thank you.
Yeah, I'm going to piggyback on that. So if a CEO finds himself, they're either starting to be in trouble or they're doing really well, might that affect their tendency to do this sort of activism?
Yeah, when we look at the determinants, we do put prior return and ROA, but we don't find any evidence that they are more likely to speak up when they are in trouble. But I think there's a little bit evidence that when they are doing well, they're more likely to speak up.
Well, I wondered about that because that may affect your results, right? I'm more likely to speak out when I'm doing well, so I'm not going to be fired anyway.
Yeah.
Yeah. All right. Well, thanks a lot, Anya. That was great.
Perfect. Thank you.
Thank you very much for including our paper on the program, and it's an honor to be here. So this is a joint work with Xiao and Tracy. So we use census data, so the usual disclaimer applies here, and we also incorporate some new results. And waiting for the disclosure. So for some tables you may now see numbers. So corporate culture is an important governance mechanism, but we actually don't know how it is formed in a firm and how it interacts with the external environment. So in this paper, we fill in this gap and tries to study the role of inter-firm interactions in determining corporate culture. So I'll first talk about the framework and design and then present results. So conceptually, we can think about the following case. So suppose there is a firm in the market, we call it firm I, the incumbent firm. And suddenly there's a new firm enters the market, the new entry called firm E. So our question is whether the culture of firm E would affect the culture of firm I. And we think the answer is yes, and it could be through the following mechanism. First, through competition, either product market competition or labor market competition, the diversity culture of firm E could affect the formal institutions of firm I, for example, gender wage gap or compensation policies in general. And after that, the firm I's culture would be affected through the within firm organizational learning. Right? And so this is a framework, and to map it to the empirical setting, we will explore the entry of $1 million plan in a county as a shock to the local incumbents' external environment. And the good thing about this design is that we will observe both the winner county and the runner-up counties for each entry event. So we have the natural counterfactual for the winner counties. So we have two sets of results. The first one is about the effects of MDP entry on the gender wage gap of local incumbents. So the design is here. So we will use the average outcome of the incumbents in the runner-up county as the counterfactual for the average outcome of the local incumbents in the winner county, and then implement a very classical diff and diff design. So here are the results. So first, if we include all the shocks, then we see when a more pro-diversity MDP coming in, then the average gender wage gap of the local incumbents decreases. Right? And second, the direction of this change actually depends on the culture of the MDP's parents. If the shocks are positive, that is, the MDP's parent is more pro-diversity than the average local incumbents, then we see both male and female wages go up, but the female wages go up more, which leads to a lower gender wage gap. And the opposite things happen when the shocks are negative. That is, the MDP's parent company is less pro-diversity than the average incumbents, then we still see like both male and the female wages go up. But now the male wages go up more relatively, so we have a larger or wider gender wage gap. Yeah.
So I'm going to break the rule here, but ask a clarification question. Can you give us a background of
Yeah, I will defer that to the 5 minutes question. Okay.
Wait, no, you should answer that one now.
Oh, okay. Okay. Yeah. So here is the background. So the data is from Blue and Dahl, 2019. So we do not collect it. They collect the data. We just take the data as given, and then we match the census data. We have 15 MDP entries. And these entries are searched online, so like it's like the news, like whether there's a $1 million plan open in a county or not, and who are the winners and who are the runner-ups. And for the industries, like half of them are manufacturing industries. Is that clear? Okay, so okay, so where right. So yeah, the negative shocks, like we observe the opposite things, and also like why we observe such changes, like we think is related to labor market competition, and here we observe the effects are the strongest for more skilled labor working in the MDP industries, and the weakest for less skilled labor working outside MDP industries, because we think like MDPs will compete with local incumbents for talents. Who tend to be more skilled and have relevant industry experience. Okay? And also like for incumbents outside MDP industries, the effects concentrate on those industries that are more connected to MDP industries. Right? So these are local effects. And then the next question is whether the changes in these formal institutions, like gender wage gap here, will lead to changes in the broader cultures at the firm level. So the previous results are at the establishment level, or more local divisions level. And the answers are not clear. It could be yes, because simply the firm's formal and the informal institutions could reflect and influence each other. But it could also be no. The recent paper by Gordon and Xantifis, it's a theory paper, and they're showing a model like if a firm can just change a gender wage gap policy, then they can just fend off the competition from competitors. So they don't need to change their culture. So we need some empirical tests. And here we will compare the change in the culture of firms that have operations in the winner county to the change of the culture in the firms that have operations in the runner-up counties after MDP's entry. So again, it's a definitive analysis. And we see the broader culture measures at the firm level also change. So we do observe changes in the formal institutions lead to changes in the informal institutions, which is diversity culture here. Right. And then the question is like, how are these changes achieved? And we think the organizational learning plays an important role. And in this table, we split the sample by the pre-treatment intensity of internal leadership rotation, which we think will facilitate the organizational learning. And we see that the effects concentrate on firms which have operations in the winner counties, like with higher intensities of internal leadership rotations. Right? So which strengthens the interpretation of organizational learning. Right? So for the sake of time, I would just summary and conclude and then take questions. So here we provide the first evidence showing that changes in the formal institutions, which is gender wage gap policy here, will lead to broader changes in corporate diversity culture. But we still think the theory paper is relevant to us because we want to know what facilitates or hampers such changes at the firm level. And the next thing we will do is to answer the question like, why do firms have incentives to learn the culture from MDPs? It's not very clear like, why do they learn? And we think it could be related to the firm's culture with respect to gender diversity and the equality. Like, for example, like one simple measure could be the female leadership at the firm. Like, if you have a more diversity, more pro-diversity MDP coming in, and if the incumbent firm's leadership are female, then they may have more incentive to learn. But for male, they may not. But we are not sure at this moment, and this is our next step.
Thank you,
Thank
Yue.
you.
Any questions, comments?
So my question is the entry of MDP to a region, is it exogenous? So can you talk about that?
Yeah, so it's kind of exogenous in the sense that we have this pair of winner and runner-up county listed here because this is like the firm will select which county to enter, and it could be several rounds of selections, and these are like maybe between these two counties, and the firms like will just select these winner counties, but for other characteristics of these counties, they could be very, very similar.
I'm going to piggyback off that. So is there any way for you to measure what the culture is in that county before the MDP comes in?
Yeah, we do have so we do have something related to that. We use the religion intensity in the county as a proxy for the county level culture. And the result is like it reduces the effects of this market competition. Like it could be through the channel that in a more religious county, like maybe female workers have less outside options. That could be the thing. And if you are curious about this spillover to the firm level, the effects is also weaker if MDP enters to a county that is more religious.
So in these counties where the wage gap decreases, do you see more female entrants into the market?
We don't have that, but we do have this. So like basically the female demand, right? We didn't show that, but here is like basically we match this MDP data to burning glass data, and we calculate the relative difference of the female demand between the MDP and the local incumbents. And as you can see, for positive shocks and negative shocks, the difference are quite similar to each other. So it's not saying like for more pro MDPs will demand more female, but so at least these are case studies, but they're not consistent with that argument.
Any other comments?
For the counties that have successfully won an MDP, I wonder if you could look at like news coverage around that to see if the deal that ultimately won included some gender preferences in terms of, I mean, in your later part of your sample, the companies actually have to disclose any government assessments and easements that they were given, and it might include, some other requirements to kind of if that is a focus of a policy focus for that county. So if they wanted to improve their gender representation, they might say, we'll give you a better tax assessment, for example, and there'll be some economic and social bullet points along that.
Okay.
So you might want to look in the news articles would usually cover it.
So the disclosures are by the firms, right?
Well, the disclosures are by the firms, but your sample is 2011 to 2019, and those were only started in like 2018. So news coverage would probably be the biggest help for your whole sample, just to see if like in the county times, like their local newspapers, they would have that discussed.
Okay, thank you.
Thanks, Amanda.
Yeah, thanks. So there have been some papers showing that the opening of large plants in local communities can actually change the incumbent firms' other behavior, like their leverage, capital structure. So I'm just wondering, like, whether the MDP actually changes the other, the incumbent firms' fundamentals, and then they change the DEI culture. So it's not exactly a spillover, but it's just they changed fundamentally how they operate. Is that possible?
Okay, I would say it could be possible, but we need to do more tests. Like by fundamental, you mean like profitability or other things. But I know like the productivity increases, right? It's because like firm will learn new technologies from MDP, so they will increase their productivity. But for productivity, So this is like just OLS regressions. Like if we think like TFP is a key determinant of culture, but like if we but like in the data is not like that. And actually, like if we take the estimate seriously, like it says like more product firms will actually have a larger gender wage gap, which is like less pro-diversity culture.
Can you observe the worker category? Because you just mentioned there is an increase in the productivity. Then it might be after they adopt more technology, so they have more jobs related to like managers instead of some frontline workers. So that may due to the gender gap decrease might be due to that they have different labor structure.
Okay, so like first in the census there is no occupation code, so from the census data it's hard to see. But again, like we can map things to burning glass and based on the occupational code there and see what like whether we see changes. But here again, so this is ex ante, but we haven't done ex post changes yet. Yeah, but we can do that.
Can I ask a question first?
Yeah.
Do you look at the mismatch in the DEI culture between the parent firm that's entering a local county and the incumbent DEI culture of firms in that county?
Yeah, so like here we like the mismatch is our treatment intensity variable here, but we don't look at that exception by exception because that would be quite noisy. So what we define here is the difference between the average local incumbents gender wage gap and the gender wage gap of MDP's parent.
I see. Yeah. My question is related to the determinant of these firms entering into a local market. Yeah, because you can tell a story that the larger mismatch between in terms of DEI culture can be an obstacle for these firms to operate in a region whose culture is drastically different from yours. But it can also be an opportunity where you can come in and address the gender wage the gender wage gap and take advantage of the supply of female employees if you are in an industry that relies heavily on female employees. Right?
Yeah. So I think these stats will help you address the questions like here, like especially the gender wage gap, both at the county level and the establishment level. Like for winner county and runner-up counties, they are not that different ex ante. So yeah.
Okay, this will be our last question.
So I want to go back to your setting. So when one MDP enters a county, and one of your mechanism is that labor competition is going to change. How is it that other counties, the neighboring counties, are not going to be affected in terms of labor supply, and also the fact that they can also go to the other county and be employed by like the area?
Yeah, it could be changed, but in my mind, like we want to find the valid counterfactual, right? Which is the runner-up county in the same events. But for the spillover to other counties, it could happen. But I would say like here we just assume the SUTBA is satisfied. There's no spillover effects.
Yeah, I think actually she has a good point. I think it would be interesting to not only look at the ones who didn't get it, but also the neighboring
to that.
counties. Yeah.
Yep.
They share the same labor force.
Yep.
All right,
That's
so
good.
thank you very much.
Yeah, thank you.
Okay. All right, hello everyone. While waiting for the slide, I'll introduce myself. I'm Hua Briscoe-Tran from the Ohio State University. All right, so let me tell you about my paper. Do employees have useful information about firms' ESG practices? The motivation starts with the recent trend in ESG investing, trillions of dollars into investing by ESG criteria. So investors have been demanding better information and ratings of firm ESG practices. But the existing ESG ratings often rely on a firm voluntary disclosure in which the firm has both the ability and the incentive to appear ESG friendly, or I call that a corporate greenwashing bias. Employees, by contrast, have an inside view of the firm that is less prone to corporate greenwashing, especially under anonymity. So I asked, do employees have useful information about firms' ESG practices? To answer that, in this paper, I extract ESG content from over 10 million employee reviews anonymously written on Glassdoor, a career intelligence site, using a word embedding machine learning algorithm. And I find that 43% of reviews mention at least one ESG keyword, so employees do care. Their inside view turned out to be highly informative beyond the existing ESG ratings in helping predicting future ESG-related outcomes for a firm, such as corporate misconduct, governance issues, downside risk, and valuation as well. And so, in addition to that, the employee inside view also appear robust to corporate greenwashing because low-cost changes in a firm's ESG policies do not affect the inside view, while high-cost changes do across many settings, including a novel exogenous shock with a court ruling. And so going forward, this means that investors and rating agencies can look into the inside view to help improve their ESG rating and investing. And going forward, I'll first describe how I measure the inside view, then assess it, and then use it to evaluate whether or not firms are walking the talk about ESG practices. I measure ESG inside view using Glassdoor data. Glassdoor was designed specifically for employees to review employers, and so they have many policies to ensure review quality. And so they become number 2 job search site as well in 2017, just because they become so popular. A typical review would look like this. On the left, you have ratings of different categories, such as work-life balance. What I want to focus on, however, is the pros and cons section here, as a novel setting of the data where employees talk about the pros and the cons of working in the firm. The idea is to capture the inside view of ESG practices by how often employees talk about ESG in the pro section relative to the con section. And so with that idea in mind, I would need a comprehensive word list for ESG topics. And so I start with the SID words, or words most frequently used by ESG rating agencies and academic papers, such as on the social topic, that would be community involvement, racism, and discrimination. And then I will use a machine learning model to, hey, could you please, machine, read all the reviews, and then understand the words and help me find similar words on this topic. And so the machine is actually the word-to-vec model, where it represents each word by a vector, and so you can compare 2 words by the 2 corresponding vectors to see how similar they are. And in the end, the model was able to pull up a list of social keywords in this case that looked not only more comprehensive, but also more relevant to employee reviews, because this model is trained on employee reviews only. And so with that idea, here's the big picture. At the top, you will see the SID words on E, S, and G separately. And then I extend it to top 500 words on each categories. And here I show you the top 50 word edits at the bottom. All of them, I guarantee you, are ESG relevant. But for example here, misappropriation, it means the intentional and illegal use of properties or funds, which is clearly a governance issue that I did not know about in advance, the word itself. And so now that I have the comprehensive word list, I can start counting and measure my ESG inside view. And so is it good? Let's assess it. So there are many ways to assess it, but today I'm going to show you one main thing, which is whether or not the inside view can predict future ESG-related outcomes for a firm relative to the existing ratings. It might not be the case for the E category because employees might not care about, let's say, carbon emission directly, while rating agencies do. But they more likely have information on the social and governance category because employee is by definition a key social stakeholder, and they observe corporate governance within the firm on a daily basis. And so is that the case? So for example here, on the E category, I look at carbon emission relative to sales. I find that a higher inside view is associated with lower carbon emission relative to sales, but it's not that significant compared to the MSCI environmental rating. For the social category, one indicator is Fortune's 100 best 100 companies to work for. And I show here that the inside view, a higher inside view is associated with a higher chance of a firm landing on this list 1, 2, or 3 years ahead. And the power here is beyond the MSCI social rating and YT as in lag-dependent variable, whether or not the firm has been on the list before. About governance, one indicator is internal control weakness, reported by a firm's external auditor. I find that a higher inside view is associated with a lower chance of a firm having an internal control weakness in the future. By contrast, the MSCI rating on governance doesn't predict anything on this dimension. And so in the paper, I also show that the inside view also predicts social violations, shareholder activism, growth, downside risk, and valuation as well, beyond the existing ESG ratings. And so the conclusion is that the inside view is informative, especially on the S and G category, beyond the existing ratings. Now, with that informativeness, we can ask the next question. So how does it compare with the existing ESG rating? Turns out the correlation with, let's say, the MSCI ESG rating is about 0.1 on average. With the Refinitiv ESG rating is even lower. Question is why? One potential reason is cheap talk. So the idea is that ratings often look at firms' disclosure of ESG policies, or goals. But firm might not follow through on these policies, goals, or commitment towards ESG. And so to evaluate this hypothesis, I study whether or not firms walk the ESG talk in many settings. And in particular, I compared 2 settings, one with and another one without a high cost of talking about ESG. And so the first setting is a business roundtable, an association of CEOs in America's largest firm, like Coca-Cola and Walmart. For a long time, these firms said they exist principally to serve their shareholders. But recently, they say, well, we share a fundamental commitment to all stakeholders, not just shareholders. And so, well, Babchak and Talarita argue that this commitment is mostly for show. They did not seek board approval or change corporate disclosure accordingly. And so it's more likely cheap talk. The second setting is unlikely cheap talk, the UN Global Compact here, because it involves high cost of reputational cost and compliance cost, because firms are publicly expelled by the UN if they fail to report progress on stakeholders. And so the list of firms looks different, like Nike and Kellogg's. And so what does it mean? If the costly signaling theory holds, and that the inside view measure is robust to corporate greenwashing or cheap talk, then the inside view is more likely to improve after the UNGC setting relative to the BRT setting. Is that the case? So I find that the change in ESG inside view after a firm signs on the BRT statement is not significantly higher for BRT firms relative to other firms. The results do not change if you look at subsample with high or low prior ESG inside view. By contrast, the change in ESG inside view after the UNGC commitment is significantly higher for the UNGC firm relative to other firms. And so these results suggest that the employees view ESG practices to improve after a commitment only when the commitment is costly. 1 minute. And so this is comparing across different firms, but we also, how about a shock within firm in terms of the cost of doing ESG? Would it change firm behavior, and again, can the inside view capture that? So the shock I look at is on sexual and racial harassment, in which, well, here's the deal. So in the United States, an employer could be held liable for workplace harassment when the harasser has some supervisory role over the victim. But then in 2013, the Seventh Circuit Court, which set legal precedent for the 3 states here, held a firm liable even when the harasser has no supervisory role over the victim. So that increased the legal risk of poor social practices, inducing this firm to improve social practices. But now, is that the case? So I look at the definitive design around it, and I find that affected firm increase their social inside view going forward relative to control firm. But we do not see the same result with the E or G category. So overall, this result suggests that inside view here is able to reflect costly changes within firm in terms of ESG practices and on the correct dimension as well. So in conclusion, all these results suggest that it's possible to learn from an inside view about ESG practices beyond the existing ESG ratings. And so investor and rating agency could use it. At the same time, because the inside view appears robust to corporate greenwashing, it could be helpful for investors who care about ESG per se. They should be very careful with those companies that look good from an outside view, but look very poor from an inside view. And that is the picture we want to take away with. Thank you.
Thanks a lot, Hua. Really nice looking slides. Any comments?
Thank you. So it's a very, very interesting paper. I want to ask about the setting. You analyze the reviews. I want to ask whether the reviews are subjective to some sort of manipulation. For example, probably the bad news, the negative comments are from the real employees. The good information might be from the employers themselves. Whether there is a way to separate these two things there.
Yep. So Glassdoor care a lot about quality control. Because of that, they try their best to address manipulation of reviews directly. And they have many policies to control that, and I'm happy to talk more on that. To evaluate manipulation directly, I do look at unusual spike in the number of reviews submitted to the website per firm per month. Remove those to see if they change my result. It doesn't. Yeah.
Your horse race is against a rating, right? But what about the firm's own disclosure? So you do have the word lists. Can you look and see how they talk about it in their filings, for example, or in their, press releases? Whatever you want to use is fine. Maybe their conference calls, to see if there's a divergence there or they're compatible. In other words, do we need to go through this exercise with Glassdoor to get to the same result?
So firm do disclose. I can look at disclosure directly, but I haven't done that. What I do is I look at the MSCI raters who actually read through all corporate disclosure and quote them in terms of whether there's a strength of good policy on ESG. And I use that as a proxy, and I find the result consistent with what I find, yeah.
Yeah, I can get it. Yeah, so one conceptual question is, so whether you are looking at the ESG or just the social dimension, because the sources are from the former employees. And it's really hard to imagine why the former employees, they care about human trafficking, or they care about some, they will review their employers based on this dimension. And another question is, Glassdoor has a metrics on the culture, why do you want to leave that? Because those are from the former employees, so they have a question about why do you want to leave that company? And then some of them, they will rate on that. I think maybe you can relate your ratings to that matrix. Yeah, this is also used in prior paper, and it's called toxic culture. Thank you.
Yeah, so ex ante, you would think the employees would talk a lot about social topics, and I do find that they have a lot of useful information on social topic. In addition to that, however, I find that they have a lot of information on governance topic as well. And so we wouldn't know that in advance, but now we know a bit better. In terms of the culture rating, yes, they do have that culture rating, and it's positively correlated with my ESG inside view measure. I do not focus on the rating itself because doing that would be not broad enough because I want to learn about E, S, and G separately. And so by doing the word list approach, I can be sure what I'm capturing and evaluate comprehensively about different dimensions of ESG. Yeah.
Okay, so our last question.
Okay, so I guess employees' happiness or satisfaction depends on social issues, but also how much they get paid. So I just wonder if, if you do a horse race also with, the employee compensation and benefit relative to, people have looked at median wage relative to the CEO wage, gender gap, and things which are a little bit more pecuniary, and whether the more soft views of the company on social issues play any role after you control for those, I would say, more pecuniary measures. Yeah.
Right. Their satisfaction with compensation matters. It positively correlated with the ESG inside view. After I controlling for the rating of compensation directly, it doesn't change the inside view predictive power actually. Yeah.
Okay, I see Pat has his hand up, but we need to move on. So grab him at lunch.
Okay,
All
thank
right,
you.
so thank you. Thank you very much.
Thank you, Laura. Thanks to the organizers for having us on the program. This paper is joint work with Bakke at Illinois, Chicago, Mathias Kronlund at Tulane, and Mahmudi from here, University of Delaware. So as somebody who likes to write papers on mergers and acquisitions, these sorts of headlines just break my heart. But this is a constant rhetoric that we hear, right, at least in the court of public opinion, that acquisitions are essentially bad for firms, right? There's this tendency for them to destroy value for firms. Now, this is backed up by academic evidence as well. This didn't just come from nowhere, right? There's plenty of studies, right, that propagate this idea that mergers and acquisitions destroy value, okay? And destroy value in the sense that they destroy value for the firms that do the acquisitions. Now, in trying to dig into this a little bit more, most of the focus of our literature has been on this issue of managerial entrenchment, right? There's this idea that entrenched managers, left to their own devices, have an incentive to build these empires, to grow the sizes of their firms for their own benefit, as opposed to focus on issues that maximize value for shareholders. Now, this tendency to engage in empire building is almost assumed to be inherent in managers' preferences, in that, meaning that there's not a whole lot we can do about it. This is just something they like to do, right? And the best we can do is perhaps redirect their attention to issues of shareholder value maximization by offering them incentives. Now, speaking of incentives, right, our starting point of this paper is this idea that principal agent models, have long advocated that we should tie pay to performance. But all the same, we also have evidence saying that there are known to be flaws in executive compensation plans. And the one we're going to focus on in particular is bonuses. And these are non-discretionary bonuses. These are bonuses that are ex ante made contingent on metrics like earnings per share or sales, for example. And the question we ask is whether these sorts of bonus contracts also contribute to value-destroying M&A activity. Now, while we're not the first to take a look at how the structure of compensation relates to mergers and acquisitions, this issue specifically, bonuses themselves, at least the type that we look at, have not been examined before. What we do know is the following, that there is this inherent elasticity between firm size and executive compensation, and there are plenty of papers that have looked at how that impacts firms' incentives to engage in acquisitions, and the evidence on that front is mixed. So the type of bonus that we study is what we term growth-promoting bonuses. Why do we call this growth-promoting bonuses? What we have in mind is bonuses that reward executives for growing a firm. So that's what a growth-promoting bonus is in theory. In practice, what this translates to, okay, and here's our data, the sorts of metrics that we classify as, of the metrics that we classify as growth-promoting, that effectively translates essentially to all of them being sales related. Okay, so you could think of these as bonuses that explicitly reward executives for growing sales. They're very prevalent. Okay, 33% of firm years in a sample, we have a CEO that has a growth promoting bonus. Okay, and if we look across our entire sample, in fact, if we look at across the unique firms that show up in a sample between 2007 and 2017, 65% of firms have one of these things at some point. Okay, and these things are not trivial. The average value is about 3 million. The median is about 1 million. Okay, so here's our main findings. Okay, first of all, we have evidence that would make it appear that that acquisitions are systematically being used to meet these bonus targets. Right? They contribute to these bonus targets, and it's plausible that they do. Right? If you think of sales, you acquire a firm. Essentially, the sales of the acquired firm become sales of the acquirer. So to put that into perspective, and I'll show you, hopefully I'll get to this in the presentation, if we think of firms that just make this bonus threshold, okay, the threshold sales, in order to trigger a bonus payout, so if we narrow this band to about 5%, if they're within 5% of making these thresholds, of those firms, between 30 and 47% turns out would not have made that threshold absent the acquisition. So sure enough, we also find that growth promoting bonus contracts are associated with a significantly increased likelihood of a firm making an acquisition. The sorts of acquisitions associated with growth promoting bonuses are acquisitions of smaller firms. Okay, they tend to be within industry acquisitions, and they tend to be acquisitions paid for with cash. And why is this interesting? These are the sorts of the types of acquisitions that much of the existing literature is associated with value creation. These are the sorts of deals that tend to actually create value for acquirers. However, in contrast, in the presence of these growth promoting bonus contracts, it turns out that acquisitions actually exhibit a higher tendency to destroy value. So if we look at a simple univariate comparison, if we split acquisitions into those where the firm where at least one executive has a growth promoting bonus versus those that don't, the ones without growth promoting bonuses have positive abnormal announcement returns on average, whereas those with a growth promoting bonus clearly appear to destroy value. Now this is of course a univariate comparison. We also examine this in a regression setting and find consistent results. Now typically when studies of mergers and acquisitions try and pick at this issue of low acquisition announcement returns, there's two prime suspects. One possibility is the overpayment, okay, for targets. We find some weak evidence that there is a higher tendency to overpay for targets in the presence of a growth promoting bonus. But primarily, the lower announcement returns for acquirers seems to be a result of acquirers selecting targets which offer lower synergies as a whole, as opposed to it essentially deals with smaller pies as opposed to acquirers giving too much of the pie to the target. So here's some results that speak to this issue of whether acquisitions are systematically being used to meet the targets for these payouts. So what we did is the following. We took the difference between the post-acquisition realized sales, okay, in the presence of these growth-promoting bonuses, and the threshold sales triggering a payout as specified in the bonus contract. So what we can see is this is a histogram of a distribution of the percentage difference between the realized sales and the threshold that is relative to the threshold. Okay, so what we see is there's a disproportionate. If we look around the boundary of 0, there's a disproportionate quantity of firms that just seem to make the target. And this is consistent. This is not new. This is not something new. This is consistent with studies that have looked at these bonus targets in a broader sense. Now, to estimate what the sales might have looked like absent the acquisition, we subtract the sales of the target firm. Okay, so we can only do this for firms for targets that are publicly listed. We subtract the target sales as identified from their pre-merger financial statements. Okay, so this is the last reported sales for the target prior to the merger. We subtract that from the acquirer sales. We have to apply this adjustment. We need to weight the target sales by the fraction of the fiscal year remaining after the acquisition, after between the date of completion and the next fiscal year end, because the acquirer only gets credit for the not the target sales for the entire fiscal year, but just a portion of the fiscal year for which the target actually belonged to the acquirer. So once we do that, we make this counterfactual adjustment, this hypothetical, that shows us that a lot of these firms that seem to have just made it turn out to not, would appear to have not made it absent the acquisition. Now, we also do this for our entire sample of deals, or we can include private deals. Instead of estimating the counterfactual sales using the target sales, we use the median enterprise value to sales multiple of the targets to estimate what the counterfactual sales would have been for the acquirer using the target sales, using the estimated target sales from this EV to sales ratio. How am I doing for time, Laurie? Okay, so I'll wrap up. So the bottom line then is that, yes, entrenchment is probably a big reason why we see value-destroying acquisitions. But unlike entrenchment, which is something we probably can't change, the best we can hope for is to redirect executives' behavior. With growth-promoting bonuses, these also appear to contribute to value-destroying acquisitions, and this is something that we have control over, right? These are things that we choose to award to executives. Again, to recap the results, it seems to be that firms systematically use acquisitions to meet the targets for these bonuses. They appear more likely to destroy value, and this seems to be largely as a result of selecting targets with low synergies.
Thank you, Aazam. Questions, comments?
Thanks, very interesting. So I'm wondering, so I'm basically thinking if I'm playing this game from the manager's point of view, I would want to pick a target that has as high sales as possible per dollar I'm paying for the acquisition. I'm wondering if you see any evidence of that.
So Spot, I mean, that's something that we have on our to-do list. We've thought of. That's exactly what we would want to see, right? That we would expect them. We wouldn't expect them to be acquiring targets with zero sales. So that is something that we plan to take a look at. I should have mentioned this is very early stage work. This is kind of a first stab at the results, but that's something we certainly intend to take a look at. Definitely makes sense. Thank you. Appreciate that.
I have a question that I might have missed. How common are these?
How common are these? Maybe went over that too quickly. If we look across firm years, 33% of our firm years have a CEO that has one of these things. And again, it's patchy. Firms have them in some years and don't. If we look across the number of unique firms that we have, 65% of firms have them at some point.
Any idea why they have them sometimes and not other times?
That's something also that's something we're looking to take a look at as well. Like, for example, if a firm makes an acquisition and then triggers the target of it, that triggers the payout of these bonuses. Something we want to take a look at is whether the firm is less likely to offer these to the executive in the future if they kind of have a sense as to what might be going on. But again, that's on our to-do list.
Other comments, questions?
Have you looked at all at likelihood of goodwill impairment down the road, or are those different across firms or across mergers?
We have actually not. That's so the idea is that with in the presence of these growth promoting bonuses, we'd expect to see more of that, right? Yeah, that's a good suggestion. Thank you. Appreciate that. We haven't taken a look at that, but we can. Right? So.
But given that you haven't found much evidence of overpayment, I'm not sure, whether how much
I guess
goodwill impairment you're gonna see down the road.
I mean, we haven't found zero evidence of it. It's just the evidence is weaker relative to the evidence we have when we look at the combined gains. So it's certainly possible. But yes, I guess that would suggest, that maybe that's less likely to be going on.
So do you see a clustering of these deals toward the second half or last quarter of the fiscal year?
That's something that's had us scratching our heads, right? Because it would actually make so long story short, we didn't see there's no clustering of this. If we look across the calendar year. I mean, the idea was that we felt, well, if you do it too close to the end of the year, right? You don't really get to claim. There's an immaterial impact on sales because most of the fiscal year has passed already, right? If you want to do it earlier, you have to have this foresight, as to how close you're going to be to this target or not. So we haven't found anything when we look at timing kind of, at a high level, but it's something we do intend to pick at a little bit more because it does make sense. I mean, there's got to be some level of awareness regarding the timing.
I think Amanda has.
And then Doran.
I was just going to say that beyond goodwill impairments, I would also just look at overall impairments, because it could be if their CEO is pushing like a rosy picture for this acquisition, that just the overall valuation, they might have been a little bit more accepting of some higher estimates there. So your assets of the target company could also be impaired. So even just goodwill suggests that they directly paid too much,
Right.
But overall impairments would suggest just a rosy picture of the target.
That's interesting. Yeah, again, something we haven't thought of.
Yeah.
Great suggestion. We can take a look at. I appreciate that. Thanks.
So I guess it's very easy to contract around that, right? I mean, you can write a contract and say this is only organic growth that we're going to compensate you for.
Yeah, great. So this is something we did take a look at. Surprisingly, there's very few, as in too small to actually do any meaningful analysis, that explicitly exclude acquisitions.
Okay. So another question. Some acquisition requires shareholder approval if you issue more than 20% of the stocks. It's kind of interesting to see if, once you need to pass the shareholder scrutiny, whether in fact these whatever growth promoting bonuses have no effect. You don't have any overpayment. I mean, you might have less power because I don't know how many of those transactions use some equity, but
we wouldn't know without taking a look. So we certainly can, right? I mean, my sense is like I think your intuition is correct that it's probably not going to be that many. These tend to be smaller deals that they do. That probably don't trigger shareholder approval. But it might be interesting, to look, maybe close to the margin of whether, there's a threshold that, determines whether or not you require shareholder approval or not, and we could try and exploit that.
I guess alternatively to see whether there is some follow-up by an activist who is kind of, whether activists are follow up. If you have those particular provisions and you do an acquisition.
That's a good idea. I like that. Thanks. We can take a look at that too.
Anybody else?
Yeah, so following up on Doran's question, do you observe stronger results with weaker ex-ante corporate governance, like institutional monitoring or board effectiveness?
We do. The one we use is CEO-chair duality, so this effect is stronger when there's a CEO-chair. Okay. We do control for a host of corporate governance measures, right? To do with compensation as well, like delta, et cetera. But we do find the one that we do find exhibits a higher tendency for this is when there's a CEO-chair.
Okay. Another question is your evidence on this value destroying deals. Do you include private targets as well?
Yes, we do both. Yeah, we do both. So if we look at public targets alone, we find similar results. If we look across the entire sample of acquisitions, we do find results as well. But again, it tends to be acquisitions of smaller targets. So.
All right, thank you. Anybody else?
Peter.
So have you looked at say on pay votes, like what shareholders think about it? And you can even look in there by sophisticated investors versus not.
That is a really interesting suggestion as well. We can take a look at that. Yeah. So the idea is that there would be some sort of backlash to this if we looked
especially
at say on pay votes.
Brand new kind of packages coming for a CEO. You can see if shareholders like or not.
That would be really interesting, actually. Yeah, we can.
The data is very easy to work with.
Yes. Yeah. Thanks, Peter.
Thank you. Anybody else? Everybody else is hungry. All right. Well, thank you, everybody. It was a really fun session. Anya's right.